If you looked only at the financial markets in 2025, you might think everything was fine. Stocks moved up and down, volatility faded in and out, and the bond market steadied, even if yields stayed higher than they once were. From a distance, the system looked stable, and yet, for millions of Americans, everyday life felt anything but. That disconnect between calm markets and anxious households wasn't an accident. It was the defining feature of the year, and it's one of the most important things to understand heading into 2026. The stock markets don't measure comfort, they measure expectation. They don't ask whether life feels affordable, they ask whether outcomes are likely. In 2025, the stock markets concluded that the worst case scenarios had been avoided. There was no deep recession, no systemic banking failure, no runaway inflation spiral. From a market perspective, that was enough. But for households, avoiding disaster isn't the same thing as feeling secure. One reason why the stock market looked calm is that uncertainty had already been priced in. By the time 2025 arrived, investors had spent years adjusting to higher rates, geopolitical tension, and slower growth. So when conditions stabilized, even at a worse level than before, the markets relaxed, but households, however, were still adjusting. They were living inside the consequences of those adjustments. Another reason markets appeared stable is that they respond faster than real life does. Interest rates change immediately, prices adjust instantly, and capital moves at the speed of information, but wages don't. Housing costs, insurance contracts, and debt obligations, they all don't. So even when markets signal that conditions are improving, the lived experience lags behind, sometimes by years, and that lag is what creates frustration. In 2025, inflation slowed. Officially, but inflation slowing doesn't mean everyday prices will fall. It means they stop rising as fast. And even though the difference sounds technical, in practice, it's emotional. A family doesn't feel relief because grocery prices have stopped rising quickly. They feel relief when grocery prices come down, and that rarely happens. So, when headlines said inflation was easing, many people looked around and wondered what they were missing. And the truth is, they weren't missing anything. They were just experiencing the economy at ground level. There's also the issue of concentration. By 2025, the stock market performance was increasingly driven by a narrow set of companies and sectors. These were large firms with high pricing power, strong balance sheets, and huge global reach. Their success supported indexes, but it didn't reflect the experience of most workers or small businesses, so the markets rose while consumer confidence lagged behind. Another reason stability looked convincing is that policymakers succeeded in preventing collapse. Central banks slowed inflation without triggering mass unemployment. Governments avoided fiscal cliffs and financial systems held, but preventing collapse often requires tightening elsewhere. The system stabilized, but at a cost. It is with this that the illusion forms. Stability is mistaken for health, but stability can coexist with strain. An economy can function while people feel squeezed. Markets can price calm while households brace, and that's what 2025 revealed. The labor market illustrates this perfectly because jobs existed and unemployment stayed relatively low. But job security felt weaker. Many roles felt transactional. Wage growth lagged fixed costs and mobility felt risky. So even with employment, people hesitated. And that's not instability in data, it's instability in psychology. Another factor behind the stock market calm was expectation management. By late 2025, investors were no longer expecting rapid improvement, but a modest growth, controlled inflation, and gradual easing. When expectations are low, outcomes feel acceptable. Households, however, weren't adjusting expectations as quickly. They were still measuring life against earlier norms. This helps explain why consumer sentiment remained fragile. People weren't reacting to headlines, they were reacting to lived experience, and lived experience told them that the economy required more effort for less reward. By the end of 2025, the illusion had fully formed. From the outside, the system looked steady. From the inside, it felt demanding. And that's the context in which 2026 begins. 2026 won't necessarily bring shock but clarity, because when stability persists without relief, people adapt. They stop waiting for normalization and build around the new baseline. That adaptation will define economic behavior in 2026 more than any policy announcement.